Hi, I'm Bianca Barlow from InvestorStream. Let's delve deeper into the European gas crisis. The combination of events that led to Europe's gas crisis during 2021 has now been exacerbated by escalating geopolitical tensions with Russia and the Ukraine, and ongoing reductions in Europe's level of domestic gas production. The reduced production is expected to continue over the next 2 decades, while demand is said to increase as a consequence of ongoing global decarbonisation initiatives. Gas consumption in the European Union has also demonstrated little price elasticity, with exploding wholesale costs not impacting demand. Current gas prices in Central Europe have been averaging approximately 400% of the usual winter peak pricing. In oil price equivalent terms, this equates to approximately $200 per barrel. The EU does not produce a high level of gas domestically, rendering it heavily reliant on imported sources of energy. In 2019, more than half its supply came from external sources. Russia is the largest source of natural gas imports to the EU, placing the EU in a situation of fragile dependency to this channel of supply. The Russian state-owned gas company Gazprom holds charge of the world's largest natural gas reserves, ensuring this dependency is likely to continue. In 2021, a number of factors contributed to a gas crunch in the EU, led by Gazprom's tightened supply. Other factors included historically low storage levels, falling domestic production, a season of decreased wind lowering renewable options, and increased demand for natural gas as the world moves towards decarbonisation. The escalating tensions between Russia and Ukraine will also have an impact on gas supply, with the EU now tabling sanctions on Russia if an invasion is launched. These tight market conditions will continue to present challenges for gas consumers. However, they are beneficial for companies that are operating in the oil and gas sector, and particularly those companies that are able to service the European domestic market. ADX Energy is one ASX-listed company that is benefiting from substantially improved market conditions for oil as well as gas. ADX receives a premium for its Austrian Brent oil and gas that is produced in the Vienna Basin fields and sold into the local gas network. ADX is expected to increase gas production within these fields to benefit from current gas prices. In addition to its existing production in the Vienna Basin, ADX will soon be testing both an oil and a gas zone discovered in its Anshof 3 well in Upper Austria. Gas production from Anshof 3 will provide a substantial, immediate new source of cash flow for ADX, with the oil zone offering further appraisal and development potential. Importantly, following recent results from earlier this year, UK-based energy advisors said that reservoirs with similar characteristics would return approximately $14 million in revenue per year. Infrastructure is also a critical component to rapidly push gas to market, and ADX is fortunate to have access to nearby oil and gas infrastructure, which enables it to get new resources rapidly and economically into commercial production. Although the gas crisis is a complex and multifaceted problem with no single solution, it is clear that to ensure sovereignty of energy supplies in the context of a decarbonising world, Europe must develop more reliable and economic domestic gas reserves. This will best be achieved through investment in developing domestic resources that meet global sustainability parameters. And on this measure, ADX is already ahead of the game.